and I come to the company and say, okay, I want to purchase goods, but I don't have money right now. Your policy is that you can wait only for 15 days or 30 days, but I will pay you after 6 months. 6 months is going to be your maturity date. Whatever is the date, you can mention, okay, today is 17 or 18, and then after 6 months, what will be the date? You will mention here, date. I will be paying you 2% interest. So this 2% is annualized. It means you will be using the money for 2% for how many days? How many months? 6. So that would be your 1% interest. So remember, anything that is present on the bill or on bonds or something, we will talk about in bonds as well. So that is annualized interest rate. You need to convert that, how much money, how much is the usage time? 6 months, 6 by 12. 1 month, 1 by 12. Right? So, and the principal amount, okay, I just bought them for $1 million goods, right? You will mention $1 million, and you will mention the interest rate after 6 months. And then when 6 months have completed, customer will come, he will take back this promissory note or sign it here like I have paid. The company also took a stamp here, okay, paid. That's it. And he give you $1 million plus 2% multiplied by 6 by 12. Answer is 100,000. So he will give you 1.1 million. That's it. Right? This is how notes receivable works. But that doesn't mean that shouldn't be the piece of paper. You also write it down here, the collateral, security here. The collateral may be office building, maybe office movable properties, for example, cars, luxury cars, or CEO car, or anything can be. Their plant, right? Their machinery or their land, right? Or even their stock as well. If I'm if Jamal and Company is also a manufacturing company who is making something, and your product is my input, so you can just collateral my stock as well. You can sell my stock and recover the money as well. So there are other types of receivable as well. We also call this miscellaneous receivable. For example, interest receivable, advances to employees. For example, an employee is working for you for the last 10 years, and you have the policy that after 10 years, company is giving you a facility, a benefit for the employees that they can ask for house loan, right? But you need to be working for us at least 10 years, right? So after 10 years, if employee asks for loan, you have to give them loan, and employee give you monthly payments or 6 months payments or annual payments back to you. So it means these are also receivables from your employees, right? Now, internal control over cash collections on account. Remember, whenever there is cash involved, the chances of fraud would be there. So how we can, control this kind of stuff? First of all, separate the cash handling duty with the accounting duty. So those persons who are receiving the cash, they must be different person, and those who are recording, they must be different person. Otherwise, if a customer pay you 5,000, you will record, if somebody is having some fraudulent mind, he will record 500, and rest of the $4,500 he can put in his pocket, and that's it. Customer, you can just sign it out, okay, customer has paid, that's it. Customer don't know about that, whether I still have to pay or not. So in that case, it creates a fairness problem. So to avoid that problem, to control the situation, separate the duties. Those who are receiving the cash and those who are recording those transactions must be two different, persons, two different departments. So bookkeepers should not handle the cash, those who are responsible for accounting. So that's why the accountants, they don't count the cash. The cash department is separate, accounting department is separate, right? Separate employee should opening the incoming mail and make a deposit. So that person who is, if you have given the facility to send us cash through mail or check through mail, so that person who is responsible to receive that mail should be different person. And that person who is depositing, similarly, cash is coming to the business by the customers, and also you are paying for your expenses, for your utility bills, also for the supplier's payment. So payments and deposits should also be handled by a different person, right? And recording should be handled by a separate person, accounting department. Lockbox system. So if you outsource the mail department to the bank, for example, bank has some kind of boxes on which the customer can just throw cash or some envelope, put inside the cash, write down their letter over there, sign down that, okay, this is my number, my invoice number, and I am paying you at this date, and my cash is settled. So bank will collect that money, write it down the specifications, send you the receipt to the accounting department. So responsibility to collect the cash is with the bank. So bank has some separate session, lockbox. The customer will send or put the money inside. That's it. That is the responsibility of bank. Who open that box and count the cash and make a list that, okay, this much person had deposited this much money against this order at this time, and it will send you the receipt. The accounting department just recorded, that's it. This is called lockbox system. But nowadays we have online facility, so this lockbox system has now losing its value. Rarely I have seen the lockbox system still working, even in third world countries. Now, here we go. The most important stuff. Evaluate collectibility using the allowance for uncollectible accounts. Sorry. Here we go. So let's talk about this. So when we are evaluating the collectibility, let's talk about its pros and cons. Whether selling on credit is good or whether selling on credit is bad, how much bad, and what are the benefits. Let's just first talk about that. Number one, customer can buy on credit, so sales and profit increases. Remember, profit is different than the cash flow. We already talked about that, right? If the profit is 100, that doesn't mean you have actual 100 in your account, right? Because maybe the cash is going to come after some time. But on your statements, you already mentioned, okay, this much is our profit, right? So there's a difference between cash flow and profit. That's why we have a need to have a separate statement, that is statement of cash flow. Otherwise, income statement is enough, right? So whenever we sell on credit, our sales increases. When our sale increases, of course, our net income also increases. The cost is that company may not collect from the customers. Some customers may got bankrupt, or there's a bad debt. Some customers are bad, they don't want to pay you, or they have a habitual habit or something. There are some, it's a real world, anything can happen, right? So what is a smart management? Smart management is that whenever you sell on credit, you make some kind of reserve so that your pattern of collection is not disturbed. In our previous lecture, we have learned the cash budget, right? In which we find out that everything we plan for loan or something, we plan to pay dividend or something, right? Everything starts from cash collections, right? If our cash collection is disturbed, that our one customer is not paying us, or our 2 or 3 customers are not paying us, then our cash budget is disturbed. When our cash budget is disturbed, then our whole planning for the next month or next 6 months, quarter, or the whole year is going to be disturbed, right? Maybe in the next one we need a big purchase of plant, and then we don't have much cash, then we delay our purchase, or maybe the price going up after that one, right? So in that case, the smart management is that they already include some kind of percentage, whether the customer pay or not pay, whether they receive the full amount or whether they receive some lower amount whatsoever, so that their planning is not going to disturb, right? So they make uncollectible account, allowance for uncollectible account. If uncollectible happens, that become our expense, uncollectible expense, right? A smart manager first create a reserve, and if something happen, then they charge that expense to here, so that our all the cash budget is not disturbed. Anything can happen, just come towards the reserve. If reserves is obsolete, if reserves are eaten, the more people you estimated that 100,000, or you can say the 100,000 worth of dollar is going to be lost in our sale of $1 million. So it means you can plan your cash on the basis of 900,000. Why? Because 100,000 is your reserve that you have made a reserve. So if actual uncollectible are 50,000, your planning is not disturbed because you based your planning on 900,000 cash received from customer. Your cash budget is not disturbed. What if your planning is so poor that instead of planning that maybe $100,000 it may not be recoverable from the customer, it happened $400,000, but you use $900,000 as cash collection from the customers, and you based your cash budget based on $900,000, then your whole planning is disturbed, right? So smart manager look at from their history, make some mathematical calculations. There are some methods to calculate this kind of reserve, so that any bad debt happen, any uncollectible expense happen, the allowance is disturbed, not our prediction, not our forecasting, or for our planning would remain the same. Anything that happen, that will be our adjusted in our reserve or in our allowance. So let's just see that, how we can create that. So allowance method, so it record collection losses based on company's collection experience. So if you have a history, you look from your past 5 years or 10 years data, okay, if we sell, so we find out that, okay, 1% or 2% or 3% normally don't give us back. No, you have a legal right, you sue them or whatsoever, but it takes so much time. So, by recovering $100,000, you are losing $150,000.